Howdy, Jacob here. Today we're looking at CPI Aerostructures in the aerospace and defense industry. 34 million market cap, 47 million enterprise value. So it looks like they do have some net debt there. Current P looks astoundingly cheap at just 2, but it looks like they do have the highest earnings that they've ever had, with the highest return on invested capital they've ever had, highest margins and everything. So we'll see whether we think that. I'll see whether I think that seems reliable or not. And growth looks pretty substantial from 2014, over doubling. But if you just look at the next year, where it had 150% revenue growth, it's actually down from there. So you're looking at pretty much no growth since 2016 on the revenue side, with the balance sheet showing 5 million in cash, with 18 million long-term debt, 2 million short-term debt. So that 20 million debt is a little bit of debt in relation to their free cash flow. We're probably seeing 2 to 3 million production of free cash flow, very low capital expenditures, really nothing. And the use of cash has just been paying down that debt, which is fine. I mean, it doesn't really add anything to the business. It just makes you more comfortable as a shareholder owning this type of business, but really that's not any form of reinvestment. Like, at least a dividend, you can, like, I'm not saying it's a bad thing, but with a dividend, you can reinvest into the stock, reinvest into other stocks. Buying back shares lessens the share count, which is, in essence, should inflate the price. And then reinvesting back in yourself at, a good rate of return could be good. But like, paying down debt is really just making you a safer company, which, again, I guess that might make sense with the 20 million that they have in relation to their 2 to 3 million in free cash flow production. So I'm not saying it's a bad thing, but you're just going to have to be aware of that when you make your assumptions, and be a little bit lighter on your revenue forecasts and such, since they're not reinvesting back into this business. They're just using it for debt. So on the revenue side, going to growth, I don't think I'm going to be seeing much growth here. Maybe 2%, and then they're just paying down debt. So, I mean, they're not going to be paying down debt forever. Even with the debt that they're paying down, it might take a little bit of time, maybe 7 to 10 years, but my analysis is 7 years. And so there's a chance that they literally just pay down debt over 7 years and give nothing to me as the owner except make the business more efficient. From a balance sheet perspective. But on the margin side, there's a lot of ups and downs here, so I'm going to be going pretty close to averages. And then on the share count side, they're not buying back shares. Stock-based compensation is about $1 million a year, so I'll probably increase that 2% a year. I'm fairly comfortable with, and we're just saying it's out of price right now. I think this 2P is a bit inflated due to the fact that their revenue is pretty high. Well, I guess revenue is not that high in relation to history, but their margins are absolutely high in relation to history. And I just question whether they'll be able to sustain that, especially since they've had plenty of negative earnings and free cash flow years in the last decade. But interesting business. I don't know if I'd be crazy interested to own it immediately, but definitely just not at the price either right now. So we'll just be waiting. Hopefully you enjoyed the video. Have a great day. Thank you.